Hi and welcome to Pleasant Trading. My name is Robinson. Today we will be looking at how to use moving averages to determine entry, exit, and how the moving averages can also warn you that a trend is coming to an end. So if we start here on our very first example of 6J, the Japanese yen, this is on a 5-minute chart. So the purple lines on my charts are of Bollinger Bands. The blue line is an 8 SMA, the red line is a 20 SMA, and the long green line on here is a 200-day moving average. I use these moving averages to help me, like I said, entry, exit, how to warn me if a trend's coming to an end. So if we start looking at this chart here, we get a flat 200, the market comes into it, can't seem to break above it. The next candle never gets above it and doesn't close above it. So we know that there's a very good potential for a downtrend coming. The market starts to trade sideways after that, tries to get back into the 200 again, can't seem to do it. Starts to go sideways again, comes down into our Bollinger Bands. At this point, this is a moment of indecision for me, and I wouldn't trade this because there's not a clear break above the 200 and there's not a clear break below or into the Bollinger Bands to form a new downtrend. So the market pulls back, tries to come back to the 200 again, can't seem to do it. Right when the market gets here on this long red candle, as we break the Bollinger Bands and then the next candle stays lower, the moving averages begin to curve over if you're looking at this, and now you have somewhat of a certifiable downtrend. And the only thing that's going to let you know if it's a for sure downtrend is a move down, a pullback, and then a continuation in the same move, in the same direction of the move down. So just looking at this chart here, we get a very nice drop here. There's actually no pullback, and it spends most of the candles are outside of the bottom Bollinger Band. Now, using your moving averages, whenever the market gets outside of the Bollinger Band, these are moments of extreme risk on either side, right? Because you can be, short this trade here and it instantly begin to pull back. Whenever it goes outside the Bollinger Band, that's normally an area that it's going to pull back into because it likes to trade in the middle of the charts here, right? Not normally at this extreme all the way on the outside of the Bollinger Band. But if we're looking at this, you get this long leg down first, you get this long, then you get a bottoming tail here. Market starts to trade sideways. We pull back into the moving averages again. We get all the way back to the top Bollinger Band, and then it gives a nice entry candle here, and then you short it again, and then after that the market trades sideways. The main reason of using your actual moving averages, though, is to tell you how much may it pull back before you decide that you want to get out. Right, so if you shorted it here at the top and you like the trade, you were moving your stop down the whole way, moving your stop down, and then all of a sudden you see this big green candle, you want to know, well, how much is it going to pull back before it starts to continue again. After a decline this big, maybe it needs to pull back to the 20, the red line here, and once it breaks above the 20, that's when you should say to yourself, well, maybe it's no longer such a good trade because this big green candle right here is probably a key sign to exit. But on the next candle, if you were still holding on to it, you could have held on to it as it gets to the Bollinger Band because now that becomes the new target, right? So maybe the 8 was the very first target when it was pulling back, and then the 20-period moving average becomes the second target as it's pulling back, and then the Bollinger Band is the last stop. If it breaks the Bollinger Band to the upside, then it's probably no longer a good short, and you should probably cash out of your short position. So looking at this, though, we come right into the Bollinger Band, and it seems to hold. We get another leg down, pull back, another leg down, and then it pulls back again and gives us another leg down, and then eventually, finally, we start to go here back into the Bollinger Band. When it comes to the Bollinger Band the last time here, you could have shorted this, but after you started seeing very small candles, that's normally a key sign to get out, right? And then you have your 20-period moving average, which is the red line, and the 8-period moving average, which is the blue line. They both start to go flat. Even the Bollinger Band starts to do a Bollinger Band squeeze, right? So you have a lot of these signals that are telling you, hey, this may be over, this may be over. And if you are still short, move your stop closer. There's no need to have a big, huge stop now because it could pop either way. And towards the ending of the day, at the market close, it starts to break lower. But as a trader, you're anticipating, because these things are, not happening all at once. They're developing, right? It's a process. And if that next candle, is not green or not red, it starts to make you feel funny depending on what side of the trade you're on. So using the moving averages will help you determine some of this, uncertainty about which way it may go. Is it going to pull back? And if it does pull back, how much? It'll pull back to normally the Bollinger Band, or to your 20, or to your 8 SMA. Those are the things that you kind of want to make sure that you're looking at all the time as a trader, right? So let's just go on to another example. I just want to show this over a few charts. If we're looking at this is a cocoa futures here on a 5-minute chart. We get the market that starts to go sideways. We break the 200, very important. Again, like I said, a break of the 200 is very important. And then we start to form a downtrend. Now, if you're short this right here at the 200, which is a very good trade, if you can get this right here at the 200, you might want to hold on to the trade as long as it can stay below the 20. Maybe here you were probably selling some of your position. Right? If you were in from the 200, you shorted it all the way down here, you see this big green candle starts to pull back into the 20, and then maybe you get out of some of your position there. But for the most part, you would still hold on to this trade. Just move your stop closer. The market, sure enough, falls down again, starts to trade sideways, and then pulls back here into the Bollinger Band, and then drops another leg down again. So like I said, you're always looking at just what the moving averages are doing. They're going to tell you what exactly may or may not happen next. This will be our last symbol here, if I can get the right one in. Okay, this is a chart of ZL, soybean, on a 5-minute chart. Same thing again happens here, where you're kind of going sideways. The market tends to go sideways, and when it's not making a big move above the Bollinger Band or below it, it's just maybe a time to not trade it because it's going sideways. And how do we know that it's going to go sideways? The moving averages are pretty much flat, right? The purple lines, the red line, the blue line, they're all pretty much flat. The candles are green, red, green, red. There's a little bit of trading in here, but that's, really risky, because the market's more likely to trade sideways because you don't have clear directions from the moving averages. But after you break the 200 here, if you notice, the moving averages are perfectly fine. And even when the market pulls back, it pulls back relatively close to the 8. Relatively close to the 8. So what does that tell you? Every time the market pulls back to the 8, that's probably a good buying opportunity, or maybe getting out of some of the position that you're already in. So those are just some ways on how you can use the 200, the Bollinger Band, and the 20 and 8 period moving averages to take trades. If it's at the top of the Bollinger Band, like I said, then it's probably very risky taking the trade at the top of the Bollinger Band, or at the bottom of the Bollinger Band, depending on which way, uptrend or downtrend. When it pulls back in the middle of an uptrend or a downtrend, if it pulls back to a moving average, is probably a good buying opportunity. Or if you were in a trade already, maybe you should think about taking some off the table. So just trading is a process, and maybe this can add to your process. Like I said before, everyone has their own way of trading, and these are just a few things of how to use the moving averages in very small ways. When they get to the extremes, the moving averages will normally tell you that, but they're not something that you should count on 110%. You should also know how to trade. So this is a very short video by Pleasant Trading. My name is Robinson. Feel free to come to the website and leave a message on our blog. Thank you.